Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 10% off, you can use code A1T10. Again, that will be a 10% discount off of any of their trials you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. Hey guys, all right, good morning everybody. Welcome back. Happy Monday to you. Hope you're doing well. And I should also just mention with the promo that just rolled, I have received word that actually A1T20 for a very limited time will actually get you 20% off any of DNA Funded's challenge lists. Just wanted to correct that. We haven't updated that promotional video, but that for a very limited time will get you 20% off any of their challenges. If that is something that you're interested in, make sure A1T20, write that down. Use the link in the description and the chat if you'd like to check them out. You can take advantage of those discounts. Okay, so markets are up here again following the kind of sell-off that we saw last week. The question is now, is this a sustained rally point? Are we going to see more upside move here? And that's to be seen. If you take a look at the S&P 500, we're in a choppy market environment. I wouldn't give this a clear indication one way or the other. I can't really tell you, oh, look, bulls have completely reversed here, but we do have to give some credit to the bulls. This is a pretty sharp bounce off of those lows. And if you saw my Telegram post inside of the group this weekend, I pointed out something that definitely has me a little bit cautious and why I think that, we did see this bounce in the last 2 days or in the last 2 trading sessions. Take a look here at the AAII Investor Sentiment Survey. Traders have gotten very bearish on the markets. However, this is a couple days delayed. It's not delayed when it drops, but it's been a few days since this report. The market was incredibly cautious, and I want to show you this. I actually added 2 new charts this weekend to help better illustrate. This is the best sentiment report that I know of in terms of a surveyed response. What you can see here is this is bullish responses versus bearish responses. Oh, I need to change that title, that name a little bit. But what you'll see here is that we've had decreasing bullishness in terms of an outlook for the stock market recently and crescendoing bearishness for the stock market right now. I think that's really interesting to point out. Nick, what's the name of the indicator on your chart? Dim, it's a custom-made indicator by A1 Trading. If you'd like to get information about the momentum indicator that we have on the screen, drop a link. We'll drop a link in the chat. You can speak directly to our support team and get some information about that. So what I wanted to point out here is that you have this rising bearish sentiment and falling bullish sentiment specifically. People are a little bit cautious on this market. And what that could mean is that perhaps, and I'll drop that link. Sorry, I think Chandler may have grabbed coffee, which is totally cool. So just drop that link there if you'd like some information about any of our indicators. So with sentiment kind of reaching a bearish peak here last week, I do think that you are due for a bit of a bounce, right? We came down to this key level of support. Then we've bounced off of those lows, pushing off of that area once more. My thought, however, is I do kind of lean towards the bearish side of this market at this time. Now, I don't have any short positions open yet. I'm considering taking a small short on the Dow Jones. I'll discuss that in just a moment. Um, but I am very curious when it comes to this market to see how this bounce is responded to. Because again, we're working off a little bit of that bearish extreme sentiment. I think everybody kind of got really bearish towards the end of the week last week, and then you had the bounce on Friday and a little bit of follow through here today. I think personally, this is a range bound market where most likely we're going to chop. We're going to see up days, we're going to see down days, but I don't really clearly see a massive run through the highs happening right now. And I also don't see just a massive no resistance or no support holding kind of sell off. I think it's probably somewhere in between where you get some choppiness. But I think bulls have got to see a recapture of this area on the S&P 500. We've got to see bulls recapture 6,000 on SPX. If that can happen, that's a great starting point for bulls to maybe work off some of this this bounce here. But for me, when I look at this, I actually have a possible short setup occurring on the Dow Jones here. So I'm looking at some momentum here that's picked up to the downside here. This one has been an interesting short setup for me because we've recently had this actually pop up on the Edgefinder as a bearish reading. At least it was this morning. It's no longer there. So I'm going to watch for it. It's close. I'll show you something here. If we go just indices for just a second and I go indices, you can see the Dow Jones is getting a -4. So we're close to this possibility of getting a short setup for me on the Dow, which is rare for me to do, but the Edgefinder also rarely does produce bearish signals. So we're close. We had a brief moment where it was a -5. It has now gone down to a -4, putting it back in neutral. But I'm not in a I'm not in a rush to short indices by any means, but there is a possible sell setup that I could be watching for this week on the Dow Jones. But again, I'm very cautious when it comes to shorting indices and do so very rarely. So I'll keep an eye on it. If I could take that trade, I'll share it inside of our Discord channel. We'll keep a close look on it. Indices outside of that look kind of pretty boring. However, silver and gold, nice bullish readings still persisting here. And we've got to talk about gold here. Can I just ask a quick question, everyone, too, in the chat? What charts would you like me to look at here today? I want to try and do this a little bit more on the streams, maybe take more chart requests, answer some questions more frequently. Let me know. What charts would you like me to look at today? Clearly, there's going to be a lot of people who want to look at gold. Gold and NASDAQ are usually pretty popular. We'll definitely take a look at both of those. Let's take a look at gold, speaking of. So I put this in our Telegram channel. Looks like gold might actually be trying to bounce here, right? Look at this. We've got gold hitting support. This was dropped in our Telegram channel, which is completely free to join, by the way. Link is in the description, and we'll drop it in the chat as well if you'd like to join that Telegram channel. But so we had this bounce back here, right? Nice little attempt here to go lower by the sellers, and bulls pushed back up. I may be looking at possibly picking up a long position on gold here this week, especially with a +8 on the Edgefinder. That is likely going to be a setup for me. I'm going to watch that, and if I take that trade, it will be shared as a signal inside of our VIP room. So I'm watching gold here. I like it. I think it has upside. I think we could go back and retest those 29.50 highs, but here's something you have to watch out for. Let me give you a bit of a warning. If you are somebody who thinks indices are on the edge of the cliff and they're gonna roll over and break these lows, which again, I'm not necessarily saying I think that will happen, but if that happens, I'm going to give it a 75% chance that gold gets pulled down with it. Now, it's not perfect. It's not always, but you have to understand, if there is a recession fear growing in this market, if that becomes more realized here by the market, gold is going to get sold too. You might think, well, it's a recession hedge. Bigger picture, yes. Short term, no. If recession concerns truly hit this market, you are likely to see gold also get sold initially. That is how it usually goes market history wise. Let's pull up gold. I'll show you. If you go back to 2020, where you had serious concerns about a recession impending because of the whole shutdown scenario, here's the big sell off that occurred. Gold sold off right alongside stocks. Okay. it bounced back more aggressively and more resiliently than stocks. But you have to understand, gold oftentimes gets sold on the onset of a recession or concerns about one. Another period of time where we had recession concerns was when inflation was going crazy in 2022. And you can see what happened to gold during that time as well, right? So we don't want to just assume, oh, if there's a recession, gold's going to rip to the moon, right? That's not quite how it works. Maybe you buy the dip after that concern, but we'll see if that happens, right? Stocks opening up here. You've got the US opening bell just hitting it. Got some requests for Bitcoin, the pound, gold, gold and silver. DAX at all-time highs. Yeah, we will definitely keep an eye on that. Lots of requests for gold. Yeah, let's do some gold markups here. So again, gold, very nice price action response. You actually gapped higher here and seem to have held that gap pretty well. Look at this. So market gaps open on the Sunday open, fills the gap, finds support, and shoots off of it perfectly. Very, very strong price action for gold here. I quite like the setup. I think there may be more upside for gold. And I'm going to watch for a possible long setup myself. We have Edgefinder confirmation getting a bullish reading. I always check this before taking trades, and I do like the scenario here. Guys, we've got an action-packed, loaded week. You have manufacturing PMI data coming out today. You have services PMI data coming out on Wednesday with ADP numbers as well. On Friday, you get the big jobs report. On Thursday, you get the unemployment claims. It is a loaded week for markets, and it is very likely that you're going to see some big swings one way or the other, and it could possibly start today. So I've got a lot of stuff on my radar, a lot of trades that I'm looking to potentially take going into this week, and I'm going to keep you guys as updated as I possibly can. I also have a new redefined approach to my YouTube channel. I'm really excited I spent a lot of time this weekend just trying to look at my YouTube channel really closely and try and figure out what I can do to make it more valuable to my audience. And we are going to be a little bit more focused on this channel on some of the things that people are really most interested in. Specifically, I'm going to gear my channel most heavily towards indices, gold, and the US dollar. That is something I just want to mention to my listeners. If you watch my videos, I'm going to be focused a little bit more heavily on US dollar, gold, and of course, like the NASDAQ. Those are popular topics on my channel. They're things that I trade the most. So I'm going to try and stay pretty focused up on those things. Of course, I'll also talk about, Bitcoin and things like that. But for the most part, I'm going to stay focused on what people really come to my channel for. Speaking of gold, look at that bounce back. Really nice hold of support here. If this doesn't hold, if you do get a rollover here, right, and we take out those lows, next stop I would say is 2780, but I do think you may have a shot at just seeing this might have been it. That might have been all the pullback we're going to get on gold, and I may look to try that in terms of a bounce trade setup. Euro dollar screaming higher here, back up to resistance for the Forex traders out there. You've got a nice overall downtrend, gone sideways here recently though. So we'll see if buyers can break out at these kind of levels. Same thing with the pound. Pound looking really strong here recently. Dollar yen, trending lower, but having a bounce here today. Dollar Swiss. Guys, the dollar in general has been very, very weak today. You have to wonder, when you're looking at the dollar index, if you're somebody who watches gold, if you're watching stocks, etc., look, dollar weakness for a while now has been perceived as strength for indices, but be cautious, because if you get some bad numbers in the labor data this week, etc., the dollar would go down, but recession concerns would be on too, causing stocks to probably struggle. If you get a good labor report, the dollar likely bounces and stocks probably go with it as well. So you have to understand how that dynamic works. It is very, very important to understand that at a pretty comprehensive level if you're going to be, a macro trader. Take a look at this. Just dropped something brand new for the Edgefinder, the new and improved U.S. economic heat map. And by the way, UK economic heat map also got finished this morning. Is now available within the Edgefinder. If you have a copy, it is completely free. But check this out. The surprise index here on the right will show you how far away a number came out from the expected value. right? So CPI beat expectations to the upside by 0.1% from the forecasted 2.9. And then we've added some color coding here to help make you understand a little bit easier if you're newer to fundamentals, trying to better understand this, where these numbers are looking. Like with CPI at 3%, we've color coded that red because it is a bit problematic for the US economy. PPI is at 3.5, PCE at 2.6, not as worrisome. Hopefully that makes sense. GDP wage growth is pretty strong in the US. Unemployment rate is pretty strong in the US. So you've got some blue here, you got some red here. But we've been working to improve this because this has been a very popular new feature. A lot of our users are loving this new feature, and we're going to continue to improve and add more to our economic heat maps on the Edgefinder. Quick look at COT data. We can take a look at what institutional money was up to in the past week. I pointed out over the weekend that you had heavy yen accumulation, which I thought was really interesting. They added long contracts to the end. They closed out short contracts. Very, very curious to see this kind of activity on the currency world front. You've got a lot of accumulation of Japanese yen. Take a look right here. You've got Japanese yen kind of peaking up here. By the way, it's gone from all the way left to almost all the way right, basically showing the long percentage here is ever increasing, right? So big institutional money seems to be buying into the Japanese yen where they used to be very short. Very interesting to see that. They also bought some NASDAQ, bought some Russell. We also saw some accumulation of gold and silver, right? Makes sense. They're up today here. So institutional money was up there. We can also take a look at the history. I want to show you something on the Japanese yen. So take a look at the Japanese yen. You can see there's been some accumulation going on. We can see that by the yellow line. That long percentage, by the way, is the net long to short percentage. And we can see institutional money consistently growing their positioning in the Japanese yen. Really interesting to watch that. So pay close attention. You can also see the historical records within our COT historical history tab. And what we see here is for the yen, there's been a pretty consistent bump to yen bullishness in recent time. Gold is pushing. Yeah, look at that. Nice push to the upside here this morning. Gold looking really good at support. Love that. I'm going to watch it for a possible trade. If I take that position, like I said, I will share it inside of our Discord. Dollar index helping that gold story with a big drop off here in dollar, and S&P 500 wobbly here at resistance. We'll see if it can break out. Again, bulls for the S&P, for the NASDAQ, you're looking for this to occur, right? Really, you're looking for that and then this to occur. That is really confirmation that bulls are back in town. But right now, again, we're at a resistance point here on the S&P 500. Let's watch it today because, again, the bears are looking for this move. You get that kind of move, there is very likely, in my opinion, more downside in the short term to come. I'm pretty neutral on where the indices are right now. I don't have a trade on. I don't have a long. I don't have a short. But again, at resistance here, let's see how bulls are able to react here. Are they able to get over that hurdle, or do bears take control and push it lower from here? Dollar index, same kind of price action story. We need to think about this. Can the bears take out the lows here, get us through those lows? Also, by the way, I should mention this, guys. We just dropped something pretty exciting. For those of you who have been waiting for a chance to pick up a copy of the Edgefinder, today might as well be Christmas. We are currently offering 35% off the Edgefinder for this week only. We just dropped a big sale. We did a giveaway last week and the week before. And so a lot of people have been exploring the tool, curious about the tool, and asking for upcoming discounts. Today's your special day. If you guys would like 35% off the Edgefinder, it's a one-time payment. So you don't have to pay monthly. You don't have to pay forever. I personally don't like that kind of purchase in my own personal spending. So we've made it an option to where you can purchase the Edgefinder and it's a one-time fee. You get access to all of our economic heat maps, the commitment of traders data. You can track crowd sentiment. You can track investor sentiment on the surveys that we just showed earlier. You can track the top setups algorithm to see the kinds of trades being generated by the Edgefinder. And we have way more features coming this year. It's going to be a big year for the Edgefinder. So get a copy before we raise those prices. We do plan on doing so with new features coming this year. So take advantage, 35% off. The way to get access to that extra stream discount is send us a direct message using the link dropped here in the chat. So there you go. Yes, 35% off. If you've been thinking about getting a copy, there's your chance. Pick it up while it's discounted. Kind of think of it like this. The Edgefinder's price is like this, Right now, it is on sale, and there is a guarantee. You don't get this in the markets, right? But there is a guarantee that the price of the Edgefinder will go back up. So if you're interested in the Edgefinder, you've been thinking about getting a copy, buy the dip before the dip is over. It is guaranteed to go back up in price. So there is a dip that you can buy, confident that the price is going to go back up. So take advantage, don't miss it. And for those who have been waiting, please send us a direct message. We'll be happy to give you some information, answer questions if you have any about the tool. So, yeah, let's see. I mean, we take a look at the S&P 500 reacting bearishly here. NASDAQ, same thing. Look at that. You know, big pop up. Looked really green this morning, fading a little bit. I'm so curious to see what happens with the indices. With gold and silver, really nice pop. Look at silver, guys, 2% up. This thing looked dead in the water last week, bouncing back. Look at the bulls taking control here. Love to see this. I did get stopped out of my silver trade. You know, we had the big sell-off, and I decided to close out of my silver trade. But with this bounce back, we're looking pretty good. I'd love to see for the bulls on a price action perspective, watching silver with me. You know, if this is a higher low, we can get a little more granular. I mean, you could drop down to the 4-hour chart and do this same analysis, but I'd be looking for this kind of price action today. We need to see bulls recapture this area that we lost, right? So again, we're playing capture the flag here with our price action. We lost this area, the bulls did, sold into it, sellers took control. We're getting the bulls trying to push back, but can they actually get above and stay above this, let's call it 31.80 level? If we can get that kind of price action, perhaps there is a buy the dip kind of mentality coming into this market. I'd love to see a closure above this area, and then maybe I'm looking to retry the silver idea that I've had a couple attempts at. I've had 1 win, 2 losses on silver, being fully transparent. You know, I'm waiting for a good confirmation to possibly take another entry there. Gold, again, really nicely holding this support level. I love the price action that we're seeing. I may drop it down on the 4-hour chart, see if I can find an entry. If I take that trade, it'll be shared in Discord, like I said. Bitcoin, we got to talk about it. Huge up move this weekend with the Trump administration kind of declaring that they're going to be doing more on their crypto reserve stuff. Will there be a lot of follow through here? Man, it's hard to say. So I'll tell you this. When it comes to the crypto exciting news, somebody asked me in our Discord chat. Let me actually see if I can find this this message. Somebody asked me in the chat. They said, Nick, you know, what's the thought on this Bitcoin thing? How many? Am I missing? Where are we at with that? Did I comment here? Bitcoin. There it is. So somebody asked me, Nick, have a look at Bitcoin. I have an active sell order. I wasn't aware of the Trump announcement. Now I feel really cooked. Should I still buy or should I sell? Market is still showing no retracement after the massive 11% rise, or anyone else. So I responded to that because, again, a headline hits you on Sunday and you open up and everybody gets all excited, right? Markets get super pumped up about the crypto news. I responded back. I said, long term, I like the idea of having a little Bitcoin exposure. Short term, however, I'm cautious on risk assets in general, despite the exciting headlines. Guys, you have to be rational with this stuff. Is there an exciting news event coming out with you know, Trump mentioning a big support for crypto with the reserve stuff? Sure, there is. But that hype can be really dangerous because what it does is it gets everybody to jump into the trade, chase the trade. And maybe there is some good news there that will be realized. Maybe this is good news for the crypto world in the longer term, but don't let that short-term kind of excitement fake you out, right? I still am cautious on risk assets at this time. I'm not looking to go chase Bitcoin heavy. And if we take a look, zoom out on the daily chart, what we can see here is that we are just testing back this 92,500 level. Now, I want to give credit. I mean, that's a really nice bounce for Bitcoin, jumping back like 10% or so yesterday. Really impressive bounce. But for price action purposes, what do we want to see? We want to see breakouts above. We want to see pullbacks and hold that area. And for me personally, I want to see an Edgefinder confirmation, which I'm not getting. So there is no trade for me on Bitcoin. There's nothing I'm doing here. I'm not looking to go long or short Bitcoin. In fact, where is Bitcoin on this list? Can I search crypto? So Bitcoin's getting a -1. So there is nothing for me to do. And while everybody's getting all pumped up and excited about crypto, great, that's fine. I'm not going to go chasing that idea. Yes, it's cool news. Maybe it turns into something. Maybe there's some big trends ahead. But right now, I'm cautious on risk assets. We've talked about this a lot. The U.S. economic heat map has been kind of scatter plotted here this morning or recently. We'll see if it causes, if we get some bigger data. Speaking of data, we just had something hit. I think we had PMI prices or something. 52.7 for final manufacturing PMI came in at 52.7, slightly better than expected. The big one here today, however, is ISM manufacturing PMI. It drops in 15 minutes. That is going to populate here. It's going to cause some movement here. What we're looking for is for PMIs to stay above 50 to show growth, right? We're specifically highlighting manufacturing in the United States. The PMIs here are forecasted to be 50.6. If they drop below 50, that is a straight up red flag. If they miss expectations, let's say it's light, right? So forecast is for 50.6. Let's say you get 50.1, right? 50.1 would also be bearish because it's missing the expectation of the market. So, we'll see that data will update in the Edgefinder for you to be able to better track. The way to read this new version is on the actual column, you have the data points and whether or not they are strong or weak or just kind of in the middle. So for example, inflation is hot, right? 3% inflation is not great. That is not good for an economy, right? It can cause some serious issues. PCE, however, that's pretty good, 2.6. It's not blue because it's not a great number. Anything around 2%, that's a great number. 2.6, however, not so great for inflation. 3%, straight up not good, right? So inflation is hot, PPI is hot, PCE is kind of mixed, wage growth strong, unemployment rate strong. So that's the way to read this new and improved economic heat map. I'm hoping that you as a user, if you're a customer of our tools here, if you are trying to get better at macro, you can come to the economic data heat maps and just straight up completely understand what you're looking at just by spending a few minutes reading through this. You don't have to click through a whole bunch of websites. It's all on one page, kept simple for you. I mentioned this earlier. One quick announcement again. We are currently doing a 35% off discount on the Edgefinder. You get access to everything I show in all my videos, what I use to find the trade setups that I take. The Edgefinder is 35% off for a very short period of time. It knocks off a significant cost to the tool. So if you're somebody who's been on the sidelines waiting for an opportunity to pick up a copy, now is your chance to do so at a super low price. Okay, quick break. And then we've got Ivan joining the show just after this.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edgefinder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
All right, we're back with Ivan. Hey, Ivan, how's it going, man?
It's going good.
It's good to have you back on the show. We do this every Monday together, talking charts, setups, and ideas for the week ahead. And speaking of the week ahead, we have a really big one. NFP reports, PMI numbers. What's on the watch list? What are you watching right now?
My dollar trade is going to absolute bottom beyond below, whatever that thing is called. It's not the word I'm going to use. But I'm looking for Trump to speaking tomorrow.
Mm-hmm.
I'm looking for an FP on Friday. And yeah, I think those are the two most important this week.
I would agree. I mean, you've got pretty big stuff with the services PMI on Wednesday, ADP on Wednesday. I mean, it's a pretty busy week. We've got stocks all over the place. The dollar's down today. What's going on with that? What are your thoughts on the dollar?
Well, that's really interesting that you might ask me that question, because it is the most important question of today. Now, it is Europe backing Ukraine, saying that we'll support Ukraine. So likely maybe a peace deal, or peace is the word. So whatever Trump did on Friday to the markets is now reversing, because Europe kind of reversed whatever he did. So Friday was an S show. So yeah, I think it's just no more escalation of that more than anything. So I think that's why dollar's falling like a ton of bricks.
Yeah, no, it makes sense. I mean, dollar index, I mean, all that stuff on Friday was really interesting, right? You had basically the fallout between relations in the U.S., Ukraine, et cetera. We'll see if there's some bounce back on that front, but really a lot of uncertainty there. And it seems, I don't know if you saw this over the weekend too, Putin even made like kind of a minerals offer to negotiate with the U.S. For the same kinds of things that the U.S. wants out of Ukraine, right? The minerals deal that the U.S. wants. Putin actually seems to want to negotiate directly with the United States on something like that, which is, again, a very big shift from where relations were for the last few years. For the last few years, it seems like, U.S. really heavily backed its European allies and Ukraine, and now seems to be kind of wanting more out of the negotiation and making harder pushes for ceasefire. We'll see what all happens there. I guess the market's reaction, however, bounce back in gold prices here this overnight or over the weekend. Stocks mixed here a little bit, and as you pointed out, dollar index lower.
There's a lot to the story of Ukraine. I just want to give people a bit of some points to research. Number one is the Budapest Memorandum. America was giving, and US and Europe was giving Ukraine the backing back in '94 that if at the point Ukraine was the third largest nuclear country, would give up them in return of security guarantees. So maybe Europe can now kind of increase its military spending. That's good for European defense stocks. I have seen the Kongsberg Group and Norwegian, by the way, Nammo, they're all having a field day at the moment. So that's kind of where to go at the moment. But what I've said earlier today is it's going to be incredibly volatile next 24 hours. So whatever you do, stay safe.
Yeah, it's a lot of stuff with the whole, Ukraine and Europe and the alliances and how closely tied are they? And it's just, again, it's a dramatic time because you have shifting kind of. I don't think that necessarily, the U.S. and Europe are just straight up at odds at this point, but there's clearly a difference in opinion on how to handle the situation. We saw a lot of European nations kind of coming to the aid of Ukraine more aggressively, and the U.S. kind of saying, "Look, a deal or deal or no deal." So we'll see. But going to be a volatile week here, despite the Ukraine and Russia stuff, simply because we have economic data coming out all over the place. In just a few minutes, we get PMIs, services PMIs are on Wednesday, manufacturing today. S&P 500 has been a chop fest here recently, back and forth. Big spike up on Friday, but again, that's preceded by a massive tank on Thursday. So do you think, Ivan, that this is a dip? Okay, so if you had to make a decision on this, S&P 500 sold off here, concerns about growth, concerns about Ukraine, concerns about tariffs, all that stuff. If you had to make a pick in 30 days, do you think the S&P 500 is higher than where it is or lower than where it is?
In how long?
30 days.
A week? 30. My crystal ball says we're going to be all-time high in 30 days.
Okay. So you think basically some of the tariff concerns and Ukraine stuff is a little overblown?
No, tariffs is definitely fun and all that jokes, but I think it's not what do you call it in English. It's not substantial. It's not like it doesn't can I even speak Norwegian now? It doesn't stand the test of time, meaning it's very powerful, but it's
Yep.
just a negotiating tactic, as for at least what the market seems to be believing, because they haven't really priced it in, because we should be much lower if so. Like it's very forceful in the moment, but then it's taken away if you just give tariffs back, like they did with Canada and Mexico. So I think that's what I'm going to say is it's very forceful now, but it's very fragile as it can just disappear out of thin air like smoke. So that's why we should be higher, because if they give pushback like China gives pushback, I think it's going to disappear at some point.
Okay. I mean, fair enough. So same question then with gold.
Mm.
So S&P 500, you think it's going to be higher in the next 30 days? And I'll answer these same questions because I know it's unfair for me to just say, you tell us what it's going. I would say for the S&P 500, I'm going to take the downside. I would say the 30 days. I think that I've been getting accused on my channel of being being a big old fat doomsday bear with some of my dramatic thumbnails and titles. But I do want to defend myself a little bit. I'm thinking that we get more downside in the short run, but that it's ultimately a nice buying opportunity. That would be my best call for S&P 500. I have more interest in buying gold, so I would give the next 30 days gold I think is higher, and S&P 500 is lower. What about gold for you?
I was trying to find where there was a stream like a couple of weeks ago, probably like 10th or something, where we're like, okay, it's going to go higher from here.
Yeah.
But then now we're back to whatever the price might have been. I'm a bit skeptical, I have to say, because I think this one actually is going to do the same as S&P. It's going to go higher if we get a solution.
So if you get a solution to what?
To the trade wars. So
okay.
Meaning if they are lifted within the 30 days, I think gold is going to be higher. So and again, it's very conditional for everyone to understand. It's conditional what's going to happen next. If we're going to have tariffs, if we're going to have a meltdown, there's no Miller agreement. Russia is now going to Putin and says, "Hey, we are best friends forever, BFFs," and gold is going to be lower. But if we say we're going to put in tariffs today and then tomorrow they're all lifted, gold is going to be higher.
Yeah, I mean, as long as there is not resolution, gold, in my opinion, should drift higher. As long as if there is resolution, stocks would pop and gold.
Yeah.
I think it's interesting, right? Because it's like we are just not getting very solid kind of outcomes to anything right now. If that changes, to your point, all of this stuff probably snaps. S&P probably snaps back higher. It's just hard to imagine right now. I think the market probably thinks too, maybe this is where the opportunity is. It's hard to imagine after that Friday conversation that we're just going to have a rosy resolution to the US Ukraine stuff. But, we'll see. Crazier surprises have certainly happened in market history. Ivan, what else are you watching? Any trades you have on right now?
I'm still short Euro dollar, New Zealand dollar, and long dollar Swissy, but you have 30 seconds to news.
Oh, yes. Thank you. Okay, let's switch over here just so we can do our all markets view. Thank you, Ivan. You saved us. We were going to get yelled at by the audience. Nick, you missed the news again. I know. Sorry. Okay, we've got everything pulled up here, guys, and we can go ahead and roll our quick breaking news. Couple seconds to go. Manufacturing PMI numbers. We'll see if this leads to any kind of follow through one way or the other. Initial reaction for stocks is slightly lower. Gold mixed. Bitcoin dropped and then is mixed.
50.3.
50.3, Ivan says. Okay. So 50.3, I wouldn't say is a bad number, but I also wouldn't say is a great number either. With the market kind of wobbly right now, I mean, look at this. You had high prices too to come with that. So ISM manufacturing prices went up and actual outlook kind of stayed flat to slightly down from forecasts. So not the ideal thing we're looking for to save the day. Dollar index continues to kind of get pummeled here. I actually thought when we gapped open, we'd see a little bit of a fade here, but completely reversed, headed lower here at this time. We'll see.
Yeah, so if you're really going to go into a bit more, manufacturing orders, new orders, was, I would argue, significant, or not even a tad, but significantly lower. It was 55 last time, and I was 48. So that is 1 into negative territory, and 2, it's more than 7 points lower. Same with employment. So that's a significant lower in for manufacturing, though manufacturing is still the most important sector, but still. And then you said prices is much higher, which makes it a bit funny that it's just 50. The overall PMI, 50.3 is just in between, just in a bullish territory, but ever so slightly lower than last time, ever so slightly lower than last time. So it's not a fantastically different number from expectation and last, but it's still in the low 50.
Yep. And anything, really this market wants to see, some solid numbers, right? It wants to see something to get us out of this funk of, okay, we're seeing economic data and outlooks for the economy. I don't know if you saw this, Ivan, but the Atlanta Now GDP, which is GDP forecast, so that the Atlanta Fed puts out a GDP Now forecast. It's widely been one of the most accurate at predicting the GDP growth, which is incredibly hard to predict. But the Atlanta Fed's GDP Now has actually been pretty accurate, and it, for the first time since 2022, has been forecasting negative GDP growth in the United States, which is fascinating. It's not been forecasted to be negative by them since, I believe it was July of 2022. And, this stuff is, economists have the hardest job in the world to try and predict the future, but it's been more accurate than a lot of the other models out there. So we'll see. I mean, with data like manufacturing PMIs and with services PMIs, you want to see these numbers beating forecasts to give you that cushion of, okay, the U.S. economy is unpredictably good, right? Or unpredictably, stronger than expected. That's a good surprise to the upside. But where we see this number falling today, is that a huge miss? No, but 50.3 doesn't get people riled up and excited. And when you have the market kind of on the edge anyways, it doesn't take much for this market to kind of sell now, ask questions later.
Yeah, it wasn't what I was hoping for. I have to argue that. But yet again, as we're back to 105 on euro, we are back to 127 on pound, and we are back to not really much more than that, but we are back to 106.6 on dollar. Yeah, okay. Yeah, I argue. For how to understand it is, this is still dollar bearishness more than anything. If it was negative as a below 50, there would be even more dollar bearishness. I think this is just another, that together with the GDP forecast is just another reason for dollar to fall. And I think that also argues my case from last week. I think I was mentioning it, where it doesn't really matter what you're doing as long as you do it well, whatever you do. Meaning, like I shorted euro last week,
Mm-hmm.
almost went to target, by the way. I don't know how many pips that's different, but it's 3 pips different. It doesn't really matter what you do. It's what matters is that you do it well. And so there was both buyers and sellers making profit here. I don't know if those who was buying have been able to get euro at the bottom for that matter, but it's don't give up just because me or you have a certain outlook or view.
Yeah, Ivan, somebody commented on my video on Sunday. I thought this was kind of cool. And I'm sure you get comments like this. There are many people who are watching probably feel this way. There's a lot of people who watch us who trade very differently. But Ivan, your point is great, because at the end of the day, you may not trade exactly like Ivan or I, or maybe you trade something different. Maybe somebody in the audience is like, oh, I only trade Bitcoin, even though Nick and Ivan don't talk about Bitcoin that much. I trade Bitcoin. Hopefully, as Ivan is pointing out, you're doing whatever you do, just do it really well. There's a marketplace for everything for a reason, right? There's people who make money trading Bitcoin, trading euro, trading dollar, trading whatever. At the end of the day, I totally agree. Do whatever you do it well. And there's nothing is perfect. Nothing is a lot of times people are like, oh, I just trade crypto because it's the easiest, or there's nothing easiest in the market. There's no currency pair that's great for beginners. I get that question all the time, Ivan, people say, which currency pair is easiest for beginners? And I always think in my head, I'm like, well, you let me know if you find it, because I'm just going to trade the beginner's pair. That's what anybody smart would do. There's no beginner, quote unquote, chart.
You know what? I actually got that question today.
Did you?
Yeah.
I get it. I'm always like, man, if you find a beginner's friendly chart, you let me know, because I'm going to trade that one all day long.
Yeah. Now, I'm not laughing off the question. I'm just having the resemblance of that's actually the question I got today.
Right.
But to answer that question very quickly, there is no beginner, but dollar is probably an easier currency to understand because it has less variable.
There's more data on it.
If you want to do something difficult,
a lot of coverage.
Do SAR or Mexican or for that matter pound, whatever interest rate is or expectations does not equal where the currency is going at the moment.
So Ivan, the gold, silver, the metals are up here today. Even copper and even natural gas. You got commodities bouncing today.
Yeah.
What do you think about? Do you think oil is another chart that is really important? So here's a trick question for you. If oil goes down, is that a good or a bad thing in terms of the markets?
Well, I'm not as invested in oil as Diddy, but I find it interesting that it's currently falling. In my mind, I think you would believe it should go higher. But I'm a bit off on the demand and supply at the moment, because we're supposed to go down like GDP wise, but inflation is keep going higher in America. That should also keep oil going higher.
Yeah, it's an interesting chart right now, because I've been trying to explain this topic that I want to get into for just a second. Yields dropping and dollar dropping has been confusing for a lot of people, why that has not led to a massive rally in the stock market, right? If yields are dropping and the possibility of an interest rate cut is improving this year, why aren't stocks and Bitcoin, and why isn't everything to the moon? Well, the thing that I point out, and it's also correlated to oil, is because if there's economic growth concerns coinciding with the fall in yields, the demand for bonds, the drop off in oil prices, that is more of a risk off move lower in yields and oil than perhaps there's great resolutions happening in the world and GDP is still strong everywhere and yields are falling and oil's falling. That would be a very positive drop in those things. So it's interesting. This is, again, you only learn this stuff through time and experience, but a drop in yields, a drop in the dollar, a drop in oil prices, sometimes if you've been looking the last few years, you'd say those are good things for stocks. But in recent times, you're getting an example of those drop-offs not necessarily being good for stocks because they're coming at the cost of growth. Metrics are missing. Like today, we saw another miss. Manufacturing PMIs missed forecasts, and manufacturing PMI prices went up. So you have sticky inflation, more kind of disappointment in the economic growth department. So you put all that together and you say yields going down right now are not a good thing. In fact, the stock market probably wants yields to hold steady or go down for the right reasons, right? So this is what we refer to in the bond market as yields going up or down for the right or wrong reasons. Right now, I would say yields are going down for the wrong reasons. I know that because we go over here, and Ivan, you always make this good point about, inflation. You are still seeing sticky inflation here in the US. So if yields were going down because this number was dropping, you'd have good news, right? But the problem is you're having yields dropping off of GDP numbers missing expectations, or unemployment rate missing expectations, things like that, which are less attractive. So just wanted to point that out because it's a really important thing to specify why yields are going up or down.
Yeah. I was supposed to say something very clever there. Anyways, thank you, Nick, for such insightful comments.
You're welcome. Now I'm ready for yours, Ivan.
I don't know why I was pulling up the dollar's Chinese one, but yeah, trade war implication over the weekend in terms of inflation and everything. I saw that China was prepared to do anything, or all measures available to keep their currency in check for the upcoming tariffs. Because that's what my brain is. I don't know. For tomorrow, I don't know why. Am I too emotional here? But yeah. Because what is really driving the dollar today, was really driving the markets, in my simple opinion, is the pricing out of risk. But I believe tomorrow we're going to price in a lot of risk, and one that we're not talking about, and we're not trading, for that matter, is one counterpart to the trade tariffs tomorrow is China. Because if we put on tariffs, which, by the way, again, it's American consumers is going to be paying those tariffs anyways, it's supposed to be, at least in my brain, it's supposed to be making inflation going higher, and that's what the link was. So I'm just waiting, like a kid in a candy store, waiting for not Candy Crush, but for inflation to go higher.
Yeah, no, I mean, China's an interesting story this year, because if we continue to see trade war escalations ramp up, it does seem like, Trump is out for everybody this year in terms of renegotiating tariffs. We saw additional tariffs placed on China. We have seen a little bit of a come off of the highs. This is the Hang Seng Index. Will we see a larger pullback? It definitely could happen if you see escalation from Trump, I think. Chinese stocks have had a good start to the year. In fact, an incredible start to the year, because I think people thought on day one, Trump was going to just hit him with a huge tariff bill. But, and as you pointed out, tariff bill does equate to essentially a tax on goods for U.S. citizens. So that's definitely worth pointing out. But it does also hurt the demand for Chinese goods, because those prices will become less competitive to other goods, and could hurt the Chinese story. But that being said, I think the market was expecting huge tariffs out the gate, and we have not seen that. Doesn't mean, however, that they aren't coming. And if they do show up more aggressively, Chinese stocks could easily, in my opinion, head back to test some key levels. 50% retracement seems pretty reasonable to me, but we'll see. You also pulled up the currency, which is definitely worth citing as well. And, I do think that the dollar index is it's just a hard one for me right now, Ivan, because you have tariff concerns, which are sort of bullish for the dollar. Well, they are bullish for the dollar, but at the same time, we're rewriting a lot of our agreements with many other nations, and that makes the U.S. kind of a little tricky. I would say, Ivan, this is probably one of the more difficult times in memory for me in terms of markets, because they're so clouded since the last few years we've been doing these streams together. Would you agree, or do you think there's some clear setups that should come out of this?
When I woke up this morning, I had a very clear mind. I was very determined of what to do. But if you look at my screen right now, it almost looks like, is Bank of Japan or somebody interfering? Because that's 300 pips up in one day, and then 100 and whatever 20 on the pullback. Like that's volatile.
Very.
That's it's whipsaw in English. Yeah. So it's that's okay. Now I feel like this is a bit crazy. I need to stay away from here because I can't be trading that. And then people are like asking, like, what's going on? Have you been trading yen? I'm like, no, I'm supposed to buy yen or sell yen pairs, but that's not a setup that I can even remotely discuss or even think about trading. It's ridiculous.
Ivan, I want to show you this chart here. This is of course, you know what this is. This is the volatility index, the VIX. But for our listeners, I think that one thing that I feel pretty confident about this year is that I do think that the uncertainty in this market will materialize in the VIX. What I mean by that is I think that the VIX, I would be pretty surprised. It could obviously happen. Everybody can be wrong about the markets, but I would be surprised if we see this year just a plummet in volatility back down to 14, 12, like we saw pre-election. I would be surprised by that. Now, why this impacts everybody who is watching this stream, every single person, no matter what you trade, the VIX is a great indicator to have on your chart because, as Ivan just pointed out with the Japanese yen, if there's yen intervention, if there's hiking of interest rates in the Bank of Japan, if there's any of that this year, or a stock market sell-off or tariff concerns, it should materialize in the VIX. I'm looking at a weekly chart. We've got a 20.8 VIX, let's call it. The reason I say I would be surprised is if this goes low, that tells you the market is not too worried about big moves. If it goes high, it's telling you the market is more concerned about big swings. And I'm not talking about stocks only. I'm talking about everything, right? Bitcoin, yen crosses, Chinese stocks, US stocks, everything kind of is absorbed, I think, into the VIX's price. So the VIX at 20 to me seems reasonable, but I would also not be surprised if we got some spikes up into mid to high 20s this year for the VIX. And, in 2022, we saw a very prolonged high VIX. I would be surprised if we don't go test high 20s this year. And I'd also be very surprised if we don't see for the VIX scoops of or if we just kind of drop back down and stay there. Maybe we drop down briefly, but I think that VIX stays elevated this year. And I think it's a little bit different than last year, where in the last 2 years, where you've had relatively low volatility across markets.
Yeah. So at least in my head and how I read it, we are above 15. 15 is like nothing is happening kind of a thing. And we are at 20. So something is happening definitely. Yeah. Second of all, I would even argue, I should have argued that we should be lower today because of the weekend. Like so whatever the situation has been handled, we are good to go kind of a thing. Yeah. Which should, send S&P 500 higher, and that's Friday move, isn't it? So it kind of did, but it kind of didn't. So what does that tell me? That tells me, since we are still elevated and we haven't dropped down, there's still risk in the market. So that goes into your risk assessment of when you're taking a trade, is not necessarily what is VIX doing, but what is the risk in the market, more than just you seeing. Because as I said earlier, we were not dropping hard on your dollar on open, that tells you that whatever Friday was, whatever the weekend was, wasn't a complete crash down of the market.
Yeah.
So since VIX is higher, Euro is higher, it's just higher volatility. Okay, that makes me maybe either reduce my lot size or expand my stop loss, or not necessarily not taking the trade, but being aware of, okay, mentally, if it hits stop loss, it's actually okay. It's actually a bit more randomness to your trading.
Sure. Well, Ivan, we've run out of time. I want to
Oh.
thank you for coming on. We have to kick ourselves out of here. But before we do that, let me just remind everybody, if you enjoyed Ivan's commentary, he has his own YouTube channel. He also does coaching calls within our Discord server. You can find him on YouTube at IvanFX. You can search him up. We'll also drop the link to his channel in the chat here while we speak. So do me a big favor, go subscribe to him. You can also reach out to him about one-on-one coaching. And if you're a member of our Discord community, send him a direct message about that coaching. He might have something special for you. So with that said, Ivan, thank you very much for coming on.
Thank you for having me.
All right. See you, Ivan. Okay, guys, I also just want to mention we're about to bring on Chris Pulver for the next part of our show, but let me just remind you, this week we are doing a 35% off discount on the Edgefinder. If you have not already heard, get yourself a copy for a super low price right now. We had a couple of giveaways the last few weeks for the Edgefinder, and now we had a lot of people explore the tools and express interest in it, so we are offering discounts to people who would like to try it out. We're calling it a bit of our spring sale here. Springtime is trying to come out, man, although it's pretty cold this morning where I am. I don't know about you guys. Anyways, 35% off on the Edgefinder is available right now. If you've been waiting for a chance to pick up a copy, now is your chance. Send us a direct message on the website. You can speak directly to our support team using the chat in the description and in the chat here below. When you click that link, just to show you what that looks like, you'll speak directly with a real person. Sometimes people come on to our chat and they say, am I speaking to a robot? No, you're speaking to a real person on our team. So if you would like some information about the sale, please click Edgefinder 35% off sale and speak directly to a member of our support team. Up next, we got Chris Pulver coming on to the show. Stay tuned.
Hey everybody, thanks for tuning into today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
All right, we're back with Chris. Hey, Chris, how's it going, man?
Good, Nick. How are you, man? How was the wild Friday to today? What are you feeling on this? I'm sure you saw the AAII. You posted that in Edgefinder.
Yes.
One of the most bearish readings I've seen since a actual bear market. Crazy amounts of sentiment swings we've seen this year.
I'm glad you brought that up because I wanted to discuss that. I also broke it out into two other unique charts. I think it can sometimes be a little hard to look at all at once. So I broke it into two segments. This is your bullishness. This is your bearishness. As you pointed out, look at the bearish sentiment. So for those who don't know, the AAII Investor Sentiment Survey is a weekly report that shows a huge number of respondents' perspective on the markets. Are they feeling bullish? Are they feeling bearish? Are they feeling neutral? Last week, Ivan was just on. We were discussing this big sell-off that we saw. And now, as you mentioned, Chris, we have 60.6% of respondents saying bearish. I mean, my perspective on that, Chris, is, look, I'm a little cautious on the market myself, but we have to remember this came out, when did that come out? Thursday?
Yep. Worst day. Like Wednesday, Thursday was a terrible plunge, 6 days red. It's like, I understand why the sentiment was deteriorating.
Yeah.
But
so that's my thought is, so guys, this 60.6%, this huge bearish spike in sentiment, when did that occur on the chart? Well, it occurred right here on this big sell-off day. Sure enough, market completely reversed on Friday and has followed through a little bit here today. But here's you asked me my take on it, Chris. My take on it is, look, if everybody's getting one side of the boat, I want to be cautious all the
Yep.
time.
Yep.
But I also think there's a possibility that we worked off a little bit of that oversold kind of nervousness. And I
Yep.
still remain kind of cautious myself. In fact, I kind of lean bearish in the short run for indices with just everything that's going on. I think longer term, it's a buy the dip opportunity. If we get a sell off down to 5,700, look, I'm going to be accumulating shares on stuff that I like. But what are your thoughts? Different? Same?
No, so I put in a couple of trades that are, well, here's a good example. I just ran an 11-year study, and I just soaked in a bunch of stuff this weekend where it's kind of like rehashing some of the strategies that I typically trade. All I did was I made a couple tweaks to the volatility index, and I ran a study where basically anytime the VIX is over 20, can I sell premium? And should I sell premium? And how do I sell premium? So it's a delta neutral or a kind of directionally neutral strategy. But
Okay.
with the VIX spiking where it has been up to 20 plus, it usually bodes pretty well for this particular strategy. So I started out this morning selling some premium, where right now out 45 days, it's pretty much like a textbook trade for me. If I go out 45 days, if we're somewhere in between this range, which is about a 7 to 8% swing, I still make money on the trade.
Yeah.
So I thought about it this way: when we came into basically 6 days of selling last week, and we had that big rip up on Friday, I thought this was protecting the lows for right now. I mean, everyone is calling this the Trump put over the weekend, which I don't necessarily agree with. I think that Trump is going to be more vocal about the markets if they start to fall.
Mhm.
I mean, case in point would be if we did make some fresh lows, President Trump will be vocal. I said this for the last month or so. I see this market this year as you've got, let's say the market's just driving along. I feel like Chris Farley and Tommy Boy when he's on that guy's desk and he's just like, blah, 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 blah. But the market's just riding along, and you have a guardrail and a guardrail. So the market's swerving around and doing its thing, but you've got equities on one side, bonds on the other side. As long as nothing breaks, this market's just going to keep humming along. We're going to still have tariff threats. We're going to have these bargaining chips. You're going to see random tweets and just noise, right? It's a lot of noise. The market, I don't think, could all of a sudden flip and say, like, we're excited, we're going to all-time highs, because nothing really changed. All we did was have terrible bearish sentiment. That's a contrarian signal, but it doesn't mean that everybody has to jump in and load back up and be buying, because if we do that, we'll go right back up and hitting all-time highs, and it's going to be too bullish, and the market's going to flip again. So, but again, I mean, this could all change with, like, tariffs could be kicked down the road. This 10% tariff in China could be like, it's 10%. Who cares? 25% could be delayed in Europe or delayed in Mexico and Canada. Who knows? Everything's supposed to be going into effect right now, but it pretty much put a floor in the way I see. We filled the election gap on the S&P. We're using this pretty strong support level. It was also right down to the same low on Friday. I wasn't surprised to see that move like intraday. It was a crazy end of the month. And usually February kind of like shrugs off all of the flows. Like big leaps are expiring in December and January. There's a lot of option expirations in that December to January cycle. And so
Mhm.
February is usually like, okay, what do we reassess? And so Mag 7 has been a big reason the market's been down. Nvidia crushed earnings, but it wasn't enough, right? Because it's like slowing the trend, and it's crushitude. It's slowing the trend, right? It's not exponentially. It's like the law of big numbers. Is it easier to make $1 billion to $2 billion or 100 billion to 200 billion? Well, it's obviously a lot harder to make $200 billion.
Yeah.
You know?
So, Chris, correct me if I'm wrong. It sounds
Yep.
like you're actually kind of in the same camp as I am in terms of, sounds like, well, based on your positioning, that you're a little bit geared up for a range bound type of environment. And I actually feel pretty strongly that there's some good kind of cushion to both sides as you're talking about.
Yep.
And that, I think we could see lower prices, but I also see that there's probably big buy the dip, kind of movements out there. I think people sometimes will hear that and they say, well, you're just saying it could go both directions. And that is kind of what we're saying. But there's that clause of we see limited room in either direction. Is that kind of what you're thinking?
Yeah, I think limited room because it's not necessarily so bearish. And I'll say this: until we start to see cracks in the spread market, until I start to see like junk bonds, AAA,
Good point.
BCs, high yield, like if the credit spreads, which are as low as they've been since like 2007, which can be scary because we obviously know what happened in 2008. But until we start to see this market cracking, I think what we're experiencing right now is what needed to happen. I don't know if I can show a leverage ETF. This is probably just, oh, everything's, you know what I'm saying? Like, I want to get a reading of, like, I'll try to find this, but there has to be it's another kind of sentiment indicator. But if you see that, like, everyone that's in loaded up, like, leverage ETFs or leverage instruments is now getting hit harder, like, that type of trader has to get beat up. And that type of trader that's experienced a 4% or 5% flush that's now down 10, 15, 20%, that's the type of trader that, like, runs for safety, right?
Yeah.
And so I think this 4 to 5% correction we've seen in the markets is being it's being displayed like it's so much worse than it actually is. Like, the index itself, I mean, to get a bearish sentiment reading that high, Nick, at a 4%, 5% correction is insane to me. But it just shows how much people are concentrating in Mag 7, concentrating in tech, concentrating in leveraged instruments, and that needs to get cleaned up. Like, that's all this really is, in my opinion. So I'm not really bullish or bearish. I'm still trading with, like, this cautiously optimistic outlook, which is, I'm building a lot of trades for this environment. If we have prices, navigating in here, that's fine. I'd still like, and you and I talked about this offline last week, but I'd still like to see maybe this market find this 200 moving average.
Yep.
And then I start to get more position for a bullish rally. Now, that rally to me is really no better than going back to the all-time highs. In fact, that's probably what my plan is this year. So if I can time this market well enough where an entry into this area that gets back to all-time highs, I'm going to try to make, without obviously risking everything, I'm just going to make a decent amount of capital and be happy, and also be protecting a lot of profit up there, because I don't know how this market necessarily goes 10, 20% higher than the all-time highs. There's just too much uncertainty and a lot of crap that can still happen in 2025 that's not that great.
You mentioned the 200-day moving average, and that, I guess, kind of sums up my thought here, is that if I look at this chart, first of all, I actually didn't realize how close we are now to the 200-day moving average. We did the old correct sideways. That is the most nice way of saying, a pullback, right? We've corrected sideways, quote unquote, because this market has gone sideways for a while, giving the moving averages a chance to catch up. My thought is that, you know what? I buy a 200-day moving average retest, but I also think in the short run, I think we're very likely to go test that, right? So, like I said, Chris, I was mentioning this to Ivan, is over the weekend, I put together some videos sharing my thoughts, and a lot of people were on, like, Nick, you're so bearish right now. And there is a difference between being outright bearish, which I think means you think it's going to break that 200-day and start seriously trending down, or what I actually would say is more just, as we always say on the channel, cautiously optimistic or cautiously bullish, which is this idea, look, markets have rolled over here a little bit. We aren't seeing this same every single day up by the dip every single time it happens. We're seeing dips sustain. We're seeing, for the first time, I would argue, for a little while, we've corrected sideways. Is it out of the question for this market to have one or two more kind of moves lower to test some long overdue areas to retest? No, I'm actually so bullish that I want prices, as you just pointed out, to work off some of this noise, some of this leverage, some of this over enthusiasm in this market. And then I think we push higher. Like, I think that the bigger theme is the bull run continues, but we need to have our 2023 10% correction, really reload the excitement about equities, and then we can push higher. But I think that when we've run for so long, we've stretched so far without any sort of good give back, flush out, if you will. It's like you got to take out the trash every once in a while and shake out the weak hands and let the diamond hand kind of people do their thing. So I think the 200-day moving average is a pretty fair assessment, in my opinion, of where I think we will test. But hey, just because I think that doesn't mean we have to. If we start breaking structure, start breaking out again, look, I'm not smarter than the market. I don't claim to be, right? I'm trading the trends. I'm looking for opportunities. I think most likely we head back and we test areas. Could be a little ugly in the short run, but I think it gives us a chance to work off some overbought readings and to work off some of that leveraged and if somebody's down 25% in their portfolio, Chris, my question to them is what are you doing right now? If you're down 25% I'm not talking a trading account, I'm talking more like a portfolio. If you're in all the Palantirs, the Coinbase, the Bitcoin, the Ethereum, and your account's down 25%, hopefully this is a wake-up call. It happens every single generation of traders, right? I mean, you get a flush out and it humbles people and they're like, okay, I'm not doing that again. But you have to have those flush outs for people to learn their lesson, and for this bull rally, in my opinion, to actually sustain itself long-term. We want healthy corrections to recalibrate and to go higher on good bearings that aren't so leveraged and so risky.
Agree. Let me ask you this. Let's look at a little bit further in the future. Let's say that we do see all-time highs again tested, let's say in the next 3 to 6 months. How much more bullish are you on the market for 2025 going into 2026? Just bullish or bearish? Like, do you think we sustain a bull market to the tune of another 10, 15%? We just came off of 20% years. Going to a third year of like, do we get a 15 to 20% rally this year?
So, the thing is, Chris, I think I have to default to what I know, which is I want to watch the sentiment indicators that we talk about so frequently. I want to watch the macro. If we rip through the highs, and it's because, the Atlanta Fed GDP now, I don't know if you saw that, actually signaled for the first time since 2022, negative GDP growth expectancy.
Yep.
So, those types of things, if you're hitting all-time highs with macro, which I would say is not bad, but not the kind of, overheating, excellent economy kind of outlook that we've had the last few years. If that's cooling and you're hitting all-time highs in price, I would argue that in that case, you might be seeing a divergence between the economy and stock market where I wouldn't trust that rally.
Right.
That's my opinion.
Yep. And also the thing to keep an eye on would be just labor data coming in later this year. Look, we have layoffs in tech. We're starting to see layoffs go into other companies. We've got a huge, massive layoff that's just happened in the federal government. So it's just been an interesting, the market is still navigating all that, right? Like, we basically chainsaw the federal government to, I'm trying to think, I listened to this over the weekend, and so let's say that Trump and Elon Musk with Doge, instead of just like finding budget items to fix and repair, they just fire people. But if we did that for the entire year, and Doge cuts 500,000 federal jobs or 800,000 federal jobs, all that's really doing is just taking back everything that the Biden administration did for the last year. It's just like all the fluffy federal jobs that were a huge point of growth, like growth last year in jobs, government, healthcare, and services industry. That's it. So if we gut, a third of that or more so, because there's probably more government jobs than anything else the last couple of years. I don't know what that looks like as far as like overall, state of the economy. I think, like you said, that's the divergence between Wall Street says one thing, Main Street shows another thing. And then on top of that, you layer in, we talked about this last week, the consumer that is still spending money is the higher end earner. Yes. Right? Like 50% of all spending right now is done by the top 10%. You go to the top 20% of demographics. So whoever is the top 20% of earners, that's about 60% of all spending in the country. So if that demographic is hurt, where and here's how they're going to be hurt: the stock market drops, that segment is hurt more. Because those, what is it? Top 10% now own like 87% of stocks or something ridiculous like that.
They're the ones that have portfolios, period.
Exactly. So they, as far as like where they spend money, what they're spending money on, when they spend money, it will completely be associated and correlated to what this stock market is doing. If we're continuing to stay near all-time highs, consumers healthy, people that have, most of the country right now is sitting like, I think 70+% of mortgages are all like 6% or less, or 5% or less, or 4% or less. Like, it's crazy how low mortgages are in the country.
I gotta tell you a quick story, Chris, because it goes with what you were just saying. In college, one of my really close friends, we traded stocks, invested in stocks together all the time. We talk about, different companies. He was so funny because we had a certain class together, and he would come to the class or not show up to the class based on what stocks were doing that day. And I don't even know if he was consciously doing it, but it plays into exactly what you're saying, because if the stock market was up that day, there's a good chance he would just skip the class. And if the stock market was down, he would come in. He wasn't doing it on purpose, but I told him about it and he's like, oh my gosh, I do that. And that is exactly what you're pointing out. When portfolios are up, people
Yeah.
feel good, they spend more, they're less scared. And in his case, when portfolio was up, he's like, I don't need school. And when it was down, he's like, I need school. But I thought it was a good comparison to what you're pointing out is, look, people have a portfolio up or down feeling that they carry with them in their spending. And so especially that upper echelon of consumers, you know, if they're feeling good, if their portfolios are all screaming higher, yeah, they're going to go on vacation. They're going to go buy a second house. They're going to go buy a car. They're going to go, you know, put money down on something. So it's really a really powerful force. Is if stock markets are up or down, it causes sentiment to go up or down with it at the most critical level of the consumer.
Yeah, and I think that what we're going to see sentiment wise is we're going to see more extremes. And honestly, with Trump as president, this administration, I'd say extremes are probably maybe noisier and overstated than what they really will be, which is why over the weekend I was running the test of like, okay, look, if this VIX, I mean, in 2022, you know, we had a bear market in 2022. Everybody felt it. It wasn't the easiest market to trade, but it also came with some pretty nice bounces, right? I mean, we had a flush down, then a bounce, 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 flush down again. And then we actually established that, you know, it was a 9-month bear market because we're making lower highs and lower lows. But if you were timing this, like every flush down was met with a pretty nice rally. And so I think over the next, let's say 30 to 60 days, let's just say 30 days, if we actually see the market, you know, stabilize off of those lows from February, literally like February 28th is a good reference point. If we stabilize off those lows, that's fine. But we don't necessarily break the highs. We don't necessarily flush lower. And there's a lot of option trading that can be done when you have higher volatility, selling that premium. The actual move is far less than the expected move because volatility is so much higher, right? When the VIX is higher and you're selling premium, you're typically taking advantage of that difference between the expected move, which is usually overstated, and the actual move, which is going to be much less, which is why that's exactly what I did this morning, which is sell a bunch of premium. And that's what I'm going to continue to do. And it's all going to be risk defined. I mean, I know that if you're thinking selling premium, like just sell a bunch of puts and just do strangles and sell, it's all defined risk for me. I know, because that way, if there is an
Iron
outlier,
condors and things like that.
yeah, like iron condors,
Dollars.
and I do like synthetics where it's like a little bit wider. So like a, you know, a 20 wide or 30 wide iron condor is almost treated like a strangle as far as the credit you receive. So instead of getting, you know, $5 of credit, I get $4.20 of credit. And so I'll sacrifice the 80 cents, but it treats it much the same way. And if we have an outlier event, I'm not stuck with that like crazy undefined risk that and I see too many equity curves that happens to, right? You can do everything right for months and months and months and make all this consistent income, and then one July to August, like we had last year, then all of a sudden people's accounts look like that because of undefined risk. And so if I can cap that undefined risk, it's like, look, I'll risk, you know, $1,000 here, a couple $1,000 here, and that's the worst I can lose. That's a lot better off than like, oh my God, I'm down, you know, 3, 4, 500% on my puts
For that
take a
outlier
loss.
VIX move. Yeah.
Exactly.
No,
For that outlier. And speaking of that, I mean, that's what last year was. If I'm taking anything away from last year, it was, I know the market was a bull market. I know we had hiccup in April, in August, and briefly right after Labor Day, and then December was no picnic and it wasn't a Santa rally. But that showed us how sensitive this market has become when it's like VIX events. We had 2 of the largest VIX single day moves ever. And on top of that, right now, Nick, this is one thing that does make me a little bit nervous going into the next, let's say 12 months or so, is there are so many instruments now that traders can trade that I'm not saying this is going to ruin liquidity, but it does make me nervous when everyone is trading. And I'm putting everyone in like light terms here, but everybody could, if they wanted to, trade just leverage instruments. Everybody. And so instead of trading the SPY, what if you traded always double X leverage? And if instead of trading Nvidia all by itself, what if you just traded double X Nvidia? Instead of Bitcoin, you traded double X, or MicroStrategy traded double? It's like, that's crazy to me that just trade the underlying, which is already crazy enough. Like
there's
Bitcoin's
enough
already
movement
volatile enough.
there.
MicroStrategy is already crazy enough. Nvidia is already going to be crazy enough. But when people are just going into leverage instruments, I just think that it's like that flow on the peripherals, and the flow is all those extra derivatives makes it where there's not really liquidity everywhere if it's being spread out like over all these other layered instruments. Does that make sense?
Yeah, no, it does.
So,
You
but at
got to
some
be
point
careful with that
they're going to
stuff.
get busted up. Like levered anything is going to it works for you and works against you. And I think that's the one
Exactly.
part about this year that's going to be so challenging is everyone that's levered looking for direction is probably going to lose. I don't see this market giving us a ton of clear direction, and that's how I'm trading. That's what it sounds like you're trading, and I'd rather take advantage of a trader's market that's not really giving us any direction. And this is again kind of a testament of like who's traded through stuff like this before? Because I have, and you've seen like booms and busts in the last 6+ years. You've been trading for almost 10 years, right?
Mhm.
So I mean,
Yep.
we've seen a lot, and I know that the market doesn't have to always go directionally up, directionally down. The market this year could be so uncertain about where it wants to go, where it can go, that it's going to be like a 2015, 2016. We're going to have like these maybe 10, 15% swings. And, when we come to like an extreme low, it's like sentiment's going to blast all these readings and everyone's bearish and it's a buy signal. And then it goes
Yeah.
too high and it's like we can't really justify these valuations. It's going to be sell signal. This American exceptionalism or this exuberance that America has experienced, like we've had the best market for a decade. We've been outpacing Europe by 3 standard deviations. Well, look at how assets are performing this year. Non-US is kicking the crap out of the US right now.
Yep.
But I'm
That's
not going to
true.
chase. Are you chasing like European stocks or European indexes or China right now? Like I'm not chasing anything.
No, I'd like some China exposure, but I can't
Yeah.
justify where it's at. I mean, that's the thing, Chris. I agree with you. I'm definitely more on the sell premium this year train. And I still like metals. I think there's some good in that, all that indecisiveness. I like metals, right?
Yep.
There's that
Yep.
little bit of a kind of upside move there that I like. So, that's where I'm pretty positioned. I like metals this year. I like selling premium this year. I think that there's some bigger discounts coming for stocks. And if they happen, I'd be cheering the opportunity to buy some things at lower prices that I've been watching for a long time. So,
Yeah.
Chris, I'm gonna back out. I'm gonna give you the floor here for 15, 30 minutes, however long you'd like to go. Take over. Before I step out, let me just remind everybody, if you are interested in the Edgefinder, we're currently doing a 35% off discount this week. You can get access to all of our different market scanning software, the AAII Investor Sentiment Surveys, Commitment of Traders Report, the Economic Heat Map that I spent all weekend refining and updating. Chris, by the way, this is the new Economic Heat Map, completely overhauled, got your actual previous forecast, and I'm working on this number actually populating blue or red based on where it's at, right? So if manufacturing PMIs are in a decent level or services PMIs, inflation, is it hot, right? So PCE is okay. That's why it's not blue or red. But then you have CPI, a little hot. So it's in the red camp. So just giving people a little bit more of a, for those who are newer to macro, but just want to understand, where's the Fed going to go based on what we see here? That's kind of the ultimate point of the heat map. We've added that new feature. Like I just said, Edgefinder is currently 35% off for a limited time. If you'd like some information about that discount, please send us a direct message using the link just been dropped in the chat or in the description down below if you're watching this at a later point. Chris, thank you very much for the conversation, man. Good speaking with you, and we'll see you back on the next one.
All right. Sounds good. Thanks, Nick.
See ya.
Cool. I'm going to go for another probably 13 minutes, everybody. Let's get through some top down. So nice little P&L day. Had a nice recovery on Friday. Like I said, I know my watermark for the year is around 195. Trading around 130 right now as far as P&L for the year. So like I said, I sold a bunch of premium. I probably have. I mean, right now this is going to be an interesting couple of weeks because what I'm liking right now, as far as just on a personal note, we've seen a big drop in the 10-year yield. We saw the dollar reverse in a big way, which I think is really interesting. That's a lot of volatility here in the dollar, by the way. So we catch a bid down here around that 106 handle, and we just get flushed today. I'm totally okay with that. And then obviously I like seeing the 10-year yield dropping to get back to normal. I don't know if we necessarily flush all the way down here. This would be screaming. Fed is anticipated right now to do 3 cuts this year. I don't know if anyone saw that last week, but that's been the big change. So the CME watch tool going into probabilities right now. This is I've taken so many old screenshots of this. Let me see if I have one. Let's go downloads Fed. Okay, so this would have been February 6th and February 7th. Let me see which one this is. Okay, here is a screenshot of February 6th. So just over a month ago, right? Or just around a month ago. This was anticipating 1 cut, maybe 2. Okay, so that one cut was coming in June with a decent probability, and then we have another one coming at the end of the year. So that was going to be our 1 to 2 cuts for 2025. Well, now we look at the present, and now we have way less time in between and more of a probability that June is now a pretty substantial gain, where that probability is now 54, almost 55%. So that's one cut coming in June, another one that gets a slight edge in September right here, and then another one by the end of the year in December. And December is kind of a toss up. It's kind of sprinkled in all over the place, like 30% for a cut, 29% for a pause. But you can see that the progress has been being made where 1, 2, and 3 cuts are now anticipated. Now, if the market is pricing this in, that should bring US 10-year yields lower. If that is the case, and I'm actually liking this right now because I'm in the market for a house and I want to see how low I can get these interest rates. And right now, by the time I'm closing in the house, is probably about a 40 to 60-day window. The more to the downside, the better. I'm actually going to be pretty stoked to see that is the case. But I'm also aware that now everything moves in a straight line. So this goes high, low, lower, high, lower, low, maybe lower, high, lower, low if I'm lucky. I don't know if we're necessarily going all the way back down here. When we were sitting at 3.6% in the 10-year, the average mortgage was around 6.05%. When we ripped up here and did the complete opposite, the average mortgage was around 7.5%. So as we've come back about 50 to 60 basis points, this average should be around like 6.5%. So I'm going to play the numbers here, and I'm hoping that if I'm talking to servicers for a new home, that I can get a 6.5 or better rate. And I'll probably still do a buy down. I'm going to try to get as low as I can to this 6%. And I know that still sucks. I mean, I sold a home at 3.5% interest rate. I sold a home at 2.7% interest rate. Now that I'm considering a new home at 6.05, I'm actually like sick about that. It's fine, but it's like, geez, I'm gonna have to make an extra 1 or 2 payments a year, just try to outpace the inflation, or not the inflation, but the interest rate. So it sucks. I think it's in a horrible situation where the market is pretty much frozen. We'll have supply catch up. Another thing to check for on the economy would be residential construction. And if homes are still being built to have supply, you got to wonder what's going to happen in the housing market in the next like 12 months. Is there going to be so much supply that's sitting there stagnant and not selling because nobody can afford to own a house at 6-7%? Well, they're going to have to either drop prices or rates are going to have to come down. The only way this market gets more affordable is rates come down or homes get cheaper. Obviously, people that have equity in their homes don't want to see cheaper homes. So the happy medium, in my opinion, would be most of the country would be willing to move and buy more properties or whatever if their rates come down, right? Because people have a boatload of cash in their homes right now, probably more so than they really need, probably more so than they should really have, because the housing market in a 3 to 5 year period should not double in price. That's crazy amounts of asset appreciation in a market that really doesn't do that. I mean, really, a home is meant to build equity. If I buy a home for $500,000 and it maintains its worth at $500,000, but I'm paying it off every month and I'm getting more equity. But now it's like I bought a home at $500,000. It's appraised at $1 million. That's only if somebody's willing to buy it at $1 million. And so either that like fluffy appraisal comes down and people are losing value in their homes, but now everyone's going to be pissed about that, or supply catches up and we see that rates can go down and make things a little bit more affordable from that standpoint. To be determined. Okay. Anyway, that's where I'm at. Top down, let's just take a look at everything. Heat map wise, I mean, we had a pretty big comeback on Monday. Risk assets, let's take a look at Bitcoin and index wise. So, S&P, let's just go SPY here. Still trading in between. I know my charts are really messy right now, but basically my trades are this. If we're not breaking highs, I'm selling premium. If we're not breaking lows, I'm selling premium. If we're in the middle, I'm making money. That's pretty much my strategy right now. I may actually look out and do some additional strategies on the call side. I think that this market is going to be struggling to make like all-time highs that are substantial. So I might look at adding in some call condor strategies this week. I still like equal weighted quite a bit, RSP and QQQE. This is another one on the Qs I'm actually watching pretty closely. The QQQ did come close to the 200 moving average. This is another one I still think gets tested. The longer it goes, I mean, here's one thing we did do. So this little flush from high to low in the Qs did take out a low, did take out a low, did take out a lows. It took out a series of structural lows here. that to me, if we go up, I could see a lower high and a lower low, and that little correction, some type of flush out, would still offer up the buying opportunity to see if we get back to the highs. So I'm not necessarily jumping in crazy bullish yet, just in case this is a bit of a relief rally, but a dead cat bounce and the market's not quite done pricing in anything bad, right? Like this was a good correction. July to April, or I'm sorry, July to August. April was a good correction last year. September briefly was a correction. December was moderate but low volume. So if we have a real correction, high, low, lower, high, lower, low, it's in this environment that I say, okay, I like taking a stab at this, trying to get back to the highs again, make a decent amount of gains, but be very protective. If we can get an opportunity to position ourselves for a low to high run, and we get back to these highs, I would be really happy with that being like one of my best trades directionally for the year. And then going into 2026, I'm way more braced for uncertainty, even more downside, because the longer this takes, let's say, and there's a couple ways this plays out. Let's say that we get some high, low, lower, low, and then we work our way back to the highs. Well, this is either working out one of two ways. This is either setting up for some like monster bullish pattern here that then breaks and goes higher and we're still making all-time highs, or my concern is that we struggle so hard to get to these valuations and maintain and justify these valuations that all this is going to do is carve out this monster rounded top, and this market's going to end up rolling over on itself. That's probably my biggest concern for 2026. If interest rates don't get better, if inflation is not truly improving, 2026, I've said this literally for the last like 3 years, like I don't know how consumers are stretched this far and this thin without finally like going broke. I mean, life is more expensive. It feels that way. I don't know how anybody's arguing the fact that it's like, oh, things are great. Things are great if you own a home and your home is worth twice what you bought it for. Things feel good, right? If your stock portfolio or whatever your portfolio is, if it's up, triple digits for the last couple of years because the market's been pretty, it's been a great vehicle to trade, right? But at some point, the market and the stock market and the real economy, they match at some point. So if Main Street is feeling recession and jobs are being lost, and that's another thing too. It's like if the markets are dropping, we're probably getting job losses. And I don't know which one leads, right? Which one is the tail wags the dog? Maybe. Does the economy lead as a real economy lead, or is it just the market crashes first and then everything else starts to fall in place? I don't know. But I'm not super optimistic for 2026. I think the market's going to have a lot of pain ahead. And I say that to this degree. I mean, I don't think this is unreasonable, but this blue line that I have here, I talked about this a lot last week, just kind of get traders positioned for like, look, we can have some wild and crazy stuff happen here. I think that the market is fine holding April, August lows, and then possibly coming back to this dip area. I also see that what happened in 2022 with our bear market is we came right down and tested a 5-period yearly moving average. 2020's COVID crash was a 5-period moving average. So on my daily time frame, if I go out, we had this big ridiculous stretch from like 2010. We tested it in 2011. We tested it in 2015. We tested it close in 2018, but not quite there, but then certainly tested it in 2020. This 5-period yearly moving average doesn't go more than like 2 or 3 years without getting tested, usually, historically speaking. So go back, 50 to 70 years, usually within about a 2 to 3 year window, this gets tested. Look at the spacing that we have, right? It tested. So I could see this sideways like garbage market right now where it's all sorts of back and forth. You got to be an income trader to generate positive returns this year. But I could see this whole thing topping out, rolling over, finding this, we're talking about a 20+% correction. That would be a healthy correction. Now, the question is, do we bounce from there, or is it worse? Because what we don't spend a lot of time doing and haven't spent a lot of time doing is, you notice how this isn't below this 5-period moving average? The market usually finds it and then rips off of it. But if we get below it and stay below it, that's when, that's ugly. That would be ugly. The last time that happened would have been in literally 2008. That would have been the great financial crisis, right? So there's your .com bubble that we got below it. I can't go back any further because I don't have enough data here. But through this crash in 2001, we were below the 200 or the 5-period yearly moving average and stayed there for years. And then back in 2007, 8, 9, same thing. We got below it and it took us a couple years to build back. That was 2008. It took us all the way to a year later, we get back to it. Now, I would say that that'd be my target, and I'm just talking future stuff here. So right now, I think the market is survive. Not really major highs, not really major lows. It's going to drive directional traders crazy. But eventually, if and when we hit this 200 move or this 5-period yearly moving average, this becomes a buy level to dollar cost average. Anything below that by another 5%, 10%, 15%, 20%. To me, that is a bargaining price. Where I think this is a heavy discount. So not only do we have a correction to get there, but anything below it, any 5% increment below it, I'm going to be averaging more in. Because at some point I believe it'll take time, but we will get back to those highs again. And so if we're below this and we get back to it, we get through it and we get back to all-time highs again, the amount of gains and wealth generation there, if you're future thinking, can be substantial. So anyway, just food for thought. I'll plant that seed out there for the next 1 or 2 years, but we'll also digest it day by day too. So, all right. That being said, let me just do a quick top down again. NASDAQ, I'm looking to see if we have, because we did flush down, we didn't quite hit the 200 moving average, which I'm still going to watch closely. If we go high, low, lower, high, lower, low, this is where I'm going to scoop up my Qs and my positioning. Look to see if we get back to the highs. I like that trade quite a bit for 2025. I still like equal weighted as well. This one also very close to hitting the 200. I still have some shares in here. The Dow, still like the Dow, but not there yet. We still need to hit this bar count. So we could come back in and fill this gap, but not break the highs. I'd still see this thing maybe sideways, right? Finding the 200 moving average, get positioned for a dip on that 200 moving average on the Dow. The Russell, I'm staying out of for right now. I still like IWD and IWX better. That's value and dividend play. VIX is still up a little bit. So we're in the 20s now. I think this is a good time to be selling premium. Dollar index crashing hard, which is totally great. I think there's still support around the 106 to 105 area. Oil, maybe a bull put spread in my future. That's about it. I've got to hit this chart alarm first. Natural gas still hanging in there. That's a diagonal spread out to 2027. Gold catching a little bit of a bid just below the 21 moving average, though. That's an aggressive move. I'm still not there yet. I think this is high, low, lower, high, lower, low, coming back to at least the 50 period. I look to see if gold can at least come back to the 50 period. So I'm not jumping in on gold yet. Silver, obviously a nice little turnaround, still well supported by all these dynamic moving averages. Bitcoin, ridiculous move, 78K all the way up to 95K. I know there's a crypto summit. There's some optimism getting pumped back into the markets. This administration is pro crypto, and the crypto community likes it so far. However, resistance. I mean, right now, this is pretty easy. You want to buy the dip. You think you can buy the dip. But until this thing kind of bottoms out, I'd say we're going to have to wait longer. I think just like with the markets, if there's uncertainty in the markets with direction, how can we think here that Bitcoin's going to give us really any clear direction? So I think if Bitcoin stays, 75K is kind of the low end and 108K is the high end. If you're accumulating at the lower end here, that's good, because eventually if we get to the highs or higher, that's a nice spot to be saying, okay, I've added some exposure here and now there's some good upside potential. But I wouldn't be like crazy bullish and tossing money at this simply because nobody knows, So on that note, I mean, some of those wild and crazy ones like Bitcoin translates into, okay, Coinbase was up to 230. Now it's down to 218. I've got some spreads out here into this month. We'll see what flows do. MicroStrategy was up to 294. Now it's gapping. It's gapped up to 294, then back down. So, not really much follow through on it right now. Copper stable. I like this 111 trade that I have in copper. Japanese yen has pulled back. I'm actually glad that I took the profit near these highs. I'm still holding FXY long. DAX. Oh my gosh, you got to be kidding me. This is fine. I'm long FEZ, but good Lord, just European stocks are just nuts, man. Wow. DAX is just ripping like crazy. FTSE ripping like crazy. Sheesh. That is some non-US money play right there. Right? Like that is like, look, US is overvalued. Where's undervalued? Europe. Europe is undervalued. Nobody wants to own Europe. Boom. I mean, this has been relentless. It is doing awesome this year. So DAX is up. FEZ is an instrument that allows me to trade similar to DAX movement. FTSE also making some fresh highs. Crazy stuff. China stalling around the September high from 2024. Brazil pulled back a little bit. I'm still long Brazil if I want to be long inflation. The MAGs, this is a nice little ETF to trade as well. Just watching to see how this plays out. There could be some buying interest here around the 200 moving average. I think there's good structure on MAGs. This is part of the reason the market's been down. The other thing that's nice about the index is, think about this. MAGs is down 15, almost 16%. The S&P is down 5 or 6%. 5%, not even 5%. I mean, I said this like this year. If I want to eliminate volatility from our portfolio, I need to focus on indexes, not individual stocks. Mag 7, arguably the safest basket of high appreciating stocks we've ever seen, right? I mean, they've had a fantastic decade plus run. If you didn't have Mag 7, you missed out. Okay, but a 15% pullback in the mags cumulative, or the aggregate, Nvidia's had 20+% swings. Amazon was down over 20%. Tesla's down 40%. Meta's pulled back 10-15%. There's a lot more volatility there. And the crazy part, if you look back to 2022, that's how bad it can get. Meta and Tesla were down 70+%, and now they're at all-time highs and everyone loves them and they're the greatest stocks ever. But I'm trying to eliminate a bunch of volatility this year. Seriously. So I think this is still a necessary rotation. This helps broaden out the market. And I said this early this year. If the market's going to broaden out, we can broaden out by going 490 plus stocks performing well, or the top concentrated stocks perform poorly, and then that money gets dumped and concentrated into the beat up stocks that haven't been performing well. So it's kind of that second camp, is that markets on the Mag 7 side people have been leaving and vacating because it's so concentrated. So they're going elsewhere. So Mag's down, but meanwhile there's a broadening where we're buying more financials and utilities and more defensive stocks and staples and things like that. So other sectors are picking up some of the weight. Bonds have come back up this year, which is pretty nice. So anyway, just stuff to consider. Speaking of Mag 7, Apple's still hanging in there. Amazon looking a little bit better. I've got some ratio spreads on Amazon. Google, I'm just dollar cost averaging in with a bunch of income trades out in the lows around 150. Meta, I still think is going to have room to drop. This is another spot where if we go high, low, a little bit of indecision, high, low, lower, high, lower, low. I think Meta needs a correction. This is one of the larger bar counts that I have. I think this is a good spot to say, okay, I'll throw some position in there, but that's not a huge pullback. It's really not. If we went high, low, lower, high, lower, low, I'm curious how that times out to get back to these highs. So I took profit in this one last week. That one's done. That was a broke wing butterfly. So that was a winner. Anyway, Microsoft still holding pretty well about that 400 handle. A lot of my ratio spreads are below that. So this one's closer, but 375 seems a little bit safer. Hopefully we're not making too much lower lows for the next couple of weeks. These are some income trades here for another $1.20 and $2.40. Netflix, I still want to see some Netflix down to this 200 moving average. I've got some income trades there as well. Nvidia, I think if you're interested in Nvidia, selling some puts, if you can afford to own the shares, like I'm doing some credit spreads, ratio spreads. A wheel strategy is one thing to consider. Just sell a put. If you get assigned, then sell a bunch of covered calls and you'll repair it. I'm pretty confident we're not going too much lower than probably like $100 to $90 would be like my lows. I sold a bunch of puts at 70 and 75, which are probably going to expire for full profit. I don't think we're necessarily ripping up here to 155 anytime soon. But I do think that this low from August here, so this resistance becomes support. I think that area right around $100 is pretty firm. We still have this kind of choppy zone as well, where we could have this eventually, like maybe below the highs off, maybe. But again, I think when you have large stocks that are still in these big ranges, you're going to have large ranges to trade. Tesla 296, working a little bit better off the lows, which is fine. I've got a couple dollar cost average positions in. This is full profit. This one's a monthly expiration here. We'd have to get below 255, but it's still another income trade. If I own shares, I will own shares. I'm going to own shares of Tesla, repair it, but there's no assignment on it right now. Not that I know of. Let me double check my portfolio here. I don't think anything got assigned on Tesla, but I will double check. Tesla, just partial shares, but no assignment. These are all like one contract ratio spreads. So if I have 100 shares in here, it's because of a ratio spread assignment, but we're not below my strike prices. So no assignment yet. Berkshire Hathaway, Warren Buffett with his massive stockpile of cash, one of the biggest on record at Berkshire Hathaway. The stock itself is up at all-time highs. I mean, if you ask Warren Buffett right now, he probably wouldn't even buy his own stock. He thinks it's also overvalued. So I'm pretty sure Berkshire is going to continue to build a war chest and get ready for a buying spree when it's time. And I don't think that time is now. And then bonds are fine. I've got this $27 max profit on bonds. Check this right here. So TLT, I looked at this last Friday. TLT, I've got a $27 max profit, and I'm trading for around $25.05. Now, I still have this trade out to the end of April. I don't have to do anything here other than wait. If it gets called away, it gets called away at $27. I still make around $2,400 per account. So it's a good trade if we're greater than 92. If we pull back and fill some of this gap, my concern is that this pulls back and then yields go back up. So I'd almost like to see the bond market rally and yields continue to soften, and then that looks better just to get called away. I'll just take the winner and move on. Okay. All right. 10-year, like I said, 10-year is heading lower. I like all the red, but I mean, obviously I see charts just like you do. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. There's 10 candles red. I don't see this necessarily being sustainable. I think we're probably going to pop back up here in the short term. I'd obviously like to see it flush lower, but I could see the 10-year yield pushing back up, which means that bond prices will be dropping a little bit. Okay. All right. That being said, JD still running with this one above $40. Alibaba is still above the crazy rip we saw above the high September. I got out of the stock. I still have some option trades. Baidu just can't catch a bid, man. I think Baidu just needs to come out and say, we also like AI, and then see if they go up to these September highs. I still have Baidu. I'm still in it. I'm collared out here to April for the 100 to 105. I might just end up generating income on that collar and then just repositioning it. I'm out of FXI, out of KWeb. I'm still in JD holding some shares. SCHD, I like it more so than SCHG. This is Schwab dividend versus Schwab growth. I like dividends a lot more. I like the Dow. And then I've got some other stocks here that all have carved out some highs. So Costco recently carved out some highs. This one was a trade. I think I took this trade off already. This one was a full profit last week. Costco last week is here. Yep. So this is an income trade that's currently up about $400. Cool. Yeah, I'm just gonna hang on to that one. That expires. Oh, that's a lead. Okay, I'm gonna the 111 trade. I might just close this whole thing down. All right, that's a pretty good gain. All right, anyway, that's it. 650. I mean, that's so far down here. We'd have to have like just a monster implosion if I'm down here at 600. Anyway, Walmart fine, probably sideways. The high might be in for the interim. Nike fine, 65 and $60 puts. Home Depot and Lowe's staying out of for right now. MasterCard, Visa still making highs. Amex. It's crazy what credit card companies are still doing. They're still making all-time highs. Johnson & Johnson Healthcare came back in a big way. Progressive at all-time highs. CB, this is Chubb. This is another insurance play. This is Warren Buffett's kind of darling, as well as I think Progressive or Geico, one of the two. But nice income trade there. Palantir, not touching it at all. Got some ratio spreads out to April and May, but they're way down here in the $40. Carvana, I don't care. Let it fall. Salesforce falling. I'll wait. So there's just stuff I gotta look at. There's some earnings this week that I want to be mindful of. Got it right here. Earnings this week that I'll be looking at. We've got OKTA aftermarket, Target. It's a lot of retail stuff this week. So kind of getting a sense, assessment of where the consumer's at. How much are they getting in sales? Have they seen less traffic in the stores? I mean, I'm curious what these overall assessments look like. So Target, big retailer, Best Buy, big retailer, Nordstrom, AutoZone for car part, Ross, Foot Locker, Abercrombie and Fitch. Let's see here. Kroger for groceries, Costco and BJ's. Those are wholesale, member groceries / other items. But yeah, this is a big like kind of retail and consumer week as far as the health of the consumer. And again, like we said earlier, is it the top 10% still spending money? The top 10 or 20% still spending money? Are they affected? So far, the market's just sitting here at all-time highs. So yeah, probably fine, probably resilient. And also keep in mind these are Q4 earnings, which I'm sure were okay, right? So it's a little bit different as we get into Q2 of this year, and we're talking about Q1 earnings. Things might be a little bit different, right? UNH. Yeah, that was. I mean, I don't know. It's okay, but I've chosen Johnson & Johnson for. I think this is possibly a range trade, but what would make me nervous would be this. I think UNH is more of a sentiment play than it is an actual technical. I think technically speaking, like this is a pretty good spot to be long. At least some resiliency back into like the 530 to 540 area. I just don't know if it's going to be, highs and lows and we just get ranges. Is this a stock that I want to own? Well, let's take a look. It probably checks a lot of boxes, and I'm going to wrap things up here in just a minute. But UNH. So profit margins lower than last year, still way below estimated value, reliable dividend, earnings forecast to grow, high level of debt. Okay, fine, but we're cutting rates. Price to earnings, that's a little on the high side for healthcare. But I mean, come on, man. Like discounted cash flow wise, it's like they're in the business. Like Humana, a little bit lower. We can take a look, but this is like one of the biggest healthcare plays ever. I think this actually is one of the bigger weightings of like the healthcare sector. So yeah, I mean, for right now, it's probably not a bad trade. Let me see what the IV is at. So UNH, this could be just a simple income trade. IV's at 63. It's pretty good. Now, again, I want to consider doing something like this with defined risk. Could I price? I don't know what the option premiums will be, but let me see if I can price this out. So if I go UNH, go out to maybe this. So the earnings play, pre-earnings, post-earnings, 45 days is kind of perfect. Maybe a profit trap in here if I really like it. So what I don't love is I've got to go 10 wide on the strikes, which is going to make this a difficult trade for me to price out the way I want. So let me try one more. So April. Nope, this is $5 wide. This might be a little bit better. If I buy a, let's say 20. So 5 wide at 20 delta, and then sell a, like that's not a bad trade. Not a bad trade. Do we go from 470 down to 400? That 400 is only an 8 delta. It's about a 95% chance of profit. Even before this is pre-earnings. Pre-earnings, yeah, I mean that's pre-earnings. I actually like that trade. I think the pre-earnings is fine. So I think I might take this trade. Yeah, I like this trade actually. So if I want to go a little bit higher up here for a profit trap, I pull in 40 cents. Nope, that's not going to do it. So a 430 by 435. Interesting. I almost wonder if my open interest is so low here, like maybe this isn't very liquid. 344 credit to $1.60 credit to an 18-cent debit. If I can get $1.50 or better, I might take this trade. It's only $1,500 of buying power. If I had to take on the assignment, I could. You're getting like $30 to $40 for a covered call. Now I take that back, about $15 to $20 for a covered call at the money, which is a pretty easy repair. If I took on any assignment below $400, we'd have to have a monster move. That would be well outside of a standard deviation. Like that'd be like a 2 standard deviation move to the downside. $400 would be down here. So United Health Group would have to be down 37% from the all-time highs. Anything is possible. But I don't know. It's not a bad trade. I'm going to kick it around. I might take this trade. UNH. April 11. and it's the 440 by 435. I'm just going to write it down so I can pull it later and see if I want to take the trade. And then the 440 sell put. Okay. So if I can get $1.50 or better, that'd be pretty good. I'd take that for an income trade. All right, that being said, I'm going to go. UHS. What is UHS? Health services. I mean, just at a glance, I'd just say it's pulling back into resistance. Resistance becoming support right on this 160 handle. Not a bad spot. 160 is pretty good technical support. So finding some past resistance to become support, positioning for a bounce, see what it looks like as far as fundamentals. Is it due to grow? How's the cash flow? How's the debt position? Yeah, take a look. UHS. I mean, checks a lot of boxes. Price to earnings, not terribly expensive. Fair value discounted cash flow looks good. How's it compared to its peers? Way below its peers. Peer average 15.3, price to earnings is 10. Yeah, not bad. Put that on the map. UHS as well. Okay. I'll let you go for today. See you soon. See you tomorrow. Bye.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.